right. Today is Monday, August 23rd. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And the reason is we're going to talk about garbage. Of course, not to anyone's surprise, the market blasted higher today in a cartoonish fashion, almost a vertical line, straight up, all green candles. No red candles allowed, remember that? But why was the market up? This is where the garbage comes. I was just watching Kramer, and he's saying it's about the vaccines. The vaccines. Regarding the FDA approval that we got for the Pfizer vaccine. Of course, in the old days, we used to have buy the rumor, sell the news, meaning we already knew ahead of time that the FDA will approve Pfizer's vaccine. How did we know ahead of time? Did it come out of the news or Dr. Fauci or Dr. Douchey, whatever? Of course not. It came out of the options market, the insider trading, the folks who already knew ahead of time that the FDA will approve the Pfizer vaccine. And they started buying calls a few weeks ago. And now we see the pump. In the old days, we would have seen sell the news and Pfizer stock would have traded down. But we are in the era of buy the rumor, buy the news, buy the aftermath, and buy forever and ever and ever. But was the FDA approval news behind the rally really? Is this the piece of news we've been waiting for all along for the market to break out higher? Of course not. And you hear a lot of other garbage, people saying the dollar is about to rip higher. Now the dollar is about to rip higher. It already ripped higher. Wow. And then we have other folks. You know that chart master over at CNBC who does the charts, the technical analysis? And again, I'm not picking on the guy. He did the job right. And he said, don't buy the dip in oil, in energy stocks. And he was right. The charts say don't buy the dip. Not right now, at least. What happened today? Crude oil prices rising significantly higher, over 5% gains for both the WTI and the Brent. So what am I trying to say here? Just give us the tickers and send us home. I'll give you the tickers, but let me talk for a little while. Perhaps one of the most understudied and underappreciated factors in the market is the element of psychology. You can read the charts all you want. You can read macro all you want, but the role of psychology is of paramount importance. There are two rules in this market. Number one, follow the Coke. Number two, understand the role of psychology. For example, last night I showed you this, the scenario analysis, and I told you we have the cancellation of Jackson Hole, and we have the rise in Delta cases slowing down the pace of economic activity and the recovery in the market. In addition, the rise in Delta is shifting the consumer behavior. The consumer is moving from risk on to risk off, spending less. Meanwhile, the market continues to be in risk on mode forever and ever and ever. But all of this damage to the economic outlook prompted the Fed to cancel Jackson Hole and perhaps, most likely, delaying tapering, pushing the can down the road. So we have a major reaction that's about to happen on Monday, meaning today. And I did the scenario analysis, and today what happened? The dollar was down big. In addition, yields went down. Not a major move yet for the bond market, unlike the US dollar. But for now, yields went down. In the fourth scenario, we discussed the US dollar going down along with yields also trading down. This will be good for crude oil prices to rise higher. Commodities, gold, inflation stocks, technology stocks, everything rallies higher. And this is exactly what we saw in the market today. Everything rallied higher. The majority of the market was trading in the upside, whether it is in the inflationary trade or the disinflationary trade of tech, growth, and momentum, all rising higher. And you already knew that, by the way. The market popped higher due to the move in the US dollar and yields, not due to the news of the FDA approval or the charts or Jupiter moving somehow. Pay attention to the Dixie, yields, and the VIX, and you'll be fine. Use these to read the psychology of the market. Combine that with the knowledge of the outlook for the direction of Coke, the flow of Coke from the Fed, and you'll be just fine. Absolutely fine. But here are some examples from the cartoonish moves we saw in the market today. Here is the chart of NVIDIA. This is a monthly chart, by the way. Straight line, vertical line to the moon. Is this a real chart or is this a meme? Is this a joke? Of course not. Here's another one. for the ticker FTNT, Fortinet. This is a stock that I own in my portfolio, and I dumped about 70% of my position in this stock, and the reason is, look at the chart. It is hysterical, absurd. But this is the state of the market today. And the reason is the Fed manipulated the market, injecting the market with coke every single day. Now we have a coked up market that defies charts, defies technicals, defies everything besides the flow of coke and the understanding of sentiment and psychology. And we no longer have any price discovery in this market, because shorts, who used to put the market on check, causing dips, corrections, the shorts are gone. Shorting is a dying practice. Why? Because shorting became a recipe for suicide in this coked up market. It goes on in one direction, up, and that's it. Green candles, no red candles allowed from this point on. And now we have this complacency. Nobody wants to check the market at all. The short interest in the market is pretty much at all-time lows. Nobody wants to short the market at all. So inherently, the market has an upside bias. But this complacency put us ever closer to the risk of a market accident that will catch the market by surprise. But for now, the party goes on because the coke is flowing in the right direction, and the psychology remains extremely bullish, extremely complacent. I just wanted to get that out of the way. And with that, we're moving on to In Focus tonight. We will talk about the FDA approval because, according to some people, this is what moved the market today. We're also going to talk about the common prosperity comment from Chairman Xi. I also want to go over macro data we got today, specifically pointing out for more and more stagflation. Forget about inflation. We're beyond that now. We're already at stagflation, according to some experts. But let's start with the FDA's approval of the vaccine from Pfizer. Of course, many are attributing the move in the market today to the vaccine news. But again, we already knew about this ahead of time. This is not a surprise to the market at all. Now, is this really good news? Does this change anything at all? If the FDA approved the vaccine, are we going to see more people taking the vaccine, perhaps getting rid of some of this vaccine hesitancy? I doubt it. If you wanted to take the vaccine, but you were holding off for an FDA approval, then most likely you're an asshole. And of course, the majority of the country is already vaccinated, by the way. When we look at the single dose, we have over almost 80% of the country already gotten one dose, at least one dose. The fully vaccinated, about 54% of the country, but we're making more progress. The number of vaccinations is reaching 1 million per day as more people rush to get vaccinated. So this approval is not a game changer at all. And by the way, they're acting as if this approval from the FDA is some sort of a stamp of confidence and transparency. This is the same FDA that actually gets paid by the same big pharma companies they're supposed to watch over. The majority of their salaries and bonuses come out of the pockets of big pharma companies. Is this a conflict of interest or what? The majority of doctors who oversee FDA drug approval receive payments from companies they monitor. Report shows. Ta-da! This is from UConn. Why is the FDA funded in part by the companies it regulates? Nearly half the agency's budget now comes from user fees, quote unquote, paid by companies seeking approval for medical devices or drugs. This is the filth, the corruption, the revolving door policy between Washington, D.C. and Wall Street. And here's a highly recommended read. It says, an FDA whistleblower's documents, commerce, corruption, and death. Look no further than former CDC Commissioner Dr. Scott Gottlieb, aka Shoe Polish Gottlieb, who wakes up in the morning, asks his wife, honey, do I have enough shoe polish in my hair today? God forbid you get a gray hair. Single gray hair, because grayness is more dangerous than COVID. And you gotta use the jet black, not just the black, the jet black. It has to say jet. But it is disgusting that every time they introduce this guy on TV, former CDC commissioner and current Pfizer and Illumina board member, aka current Big pharma bitch. And they say it with a guilty look on their faces. Like, let's move on. Let's say it a little faster. Let's move on. This is the revolving door across the government, not just the FDA, by the way, which is owned by Pfizer. We have the FAA owned by Boeing. We have the EPA owned by chemical and big oil companies. We have the Pentagon owned by Lockheed and soon by Jeff Bezos. This is the revolving door policy. Even the generals, when they graduate from the Pentagon, they choose to work at JP Morgan. But you know who's trying to crack down on corruption? No, not in this country. It is happening in China. And of course, when the Chinese crack down, it's not just a crackdown, it's your kneecaps are going to be gone, you're going to lose a few teeth here and there. And now we have Chairman Xi using the term common prosperity over and over and over and over again. Of course, China in recent months, in recent weeks, has been cracking on Chinese companies, monopoly, big tech kind of companies over in China. And we've been seeing the performance of Chinese stocks, the likes of Alibaba, down big, JD, Pinduoduo, etc., etc. But now the Chinese are cracking on the rich, and they are doing so to address the wealth gap problem. Now, here in the United States of America, we have the largest wealth income inequality gap in history. We have the largest one in any modern nation. For now, we don't have any anger in the country because the poor, we give them food stamps, stimmies, we continue to stimulate, we stimulate loyalty to the system by cash. But at some point, with this extreme wealth gap, something wrong is going to happen. And the Chinese are trying to avoid the dire outlook for the United States of America. Because this is no longer capitalism, by the way. This is no longer the American dream. This is gangsterism. The Fed printing money out of thin air, and magically the funny money reaches the pocket of the rich, the 1% and the Wall Streeters. The rest of us, let them eat stonks, says Jerome Antoinette. And the Chinese are now realizing this will be another problem that the CCP will have to deal with, creating this massive income inequality in a so-called communist country. But the main question for the market is, what is the extent of this crackdown? How long will it take for Chairman Xi and the CCP to start cracking down on US-based companies, the likes of Apple, Nike, Starbucks, etc.? This is when we're going to get into a massive problem in the stock market. But for now, we're just keeping an eye on China because they're heading French companies, and we have the richest man in the world falling to number 3. Oh, the agony. Monsieur Bernard Arnault is now at number 3. And if he has a GoFundMe page, I will go in and donate $20 to ease his pain and suffering. But let's move on to the macro part, pointing out for more inflation. Stagflation now. We're beyond inflation. We're heading into stagflation. In the morning, we got more data regarding the housing market, specifically for existing home sales. Existing home sales rise for the second straight month. Existing home sales rose 2% to a seasonally adjusted 5.99 million units in July, from a month earlier, according to the National Association of Realtors. June total units sold were also revised up from 5.86 million to 5.87 million. The results outpaced analyst expectations of a decline of half a percentage point and 5.83 million units, according to Bloomberg consensus estimate. The median existing home price for all housing types in July was $359,900, up 17.8% from July of 2020, as each region saw prices climb. This marks 113 straight months of year-over-year gains, but marks a slowdown from the 20 to 29% price growth from a year ago. Pay attention now. The median price growth was lifted by more sales of homes above $500,000 in price. Last month, the S&P CoreLogic Case-Shiller National Home Price Index, how many titles, posted a 16.6% annual gain in May, up from 14.8% in April, making the highest reading in more than 30 years of data. We have a severe shortage of single-family homes in the country. We have never recovered the inventory of homes since the 08-09 crash. We have corporations, shell companies scooping single family homes across the country because they want to rent them, they want to be in the landlord business, and they are pushing housing prices higher while pushing the supply of homes down. So good luck finding a home if you are poor or middle class. Good luck. We're seeing the number of homes sold rising higher slightly. Now, combine all of this information, by the way. Existing home sales rising higher. Prices continue to rise higher. The inventory coming out of the upper end, the higher end of the market, with homes priced above $500,000. When you look at the average prices, they're well above $1 million. What does that mean in plain English, please? It means we have certain homeowners been thinking about selling their home, but they've been waiting and waiting because prices continue to rise higher and higher. And now they're starting to think that perhaps the mania has peaked. We have reached peak housing prices. This is the top. And it is a good time to start dumping homes. So we're seeing the rise in supply from the higher end of the market as some start to believe that perhaps the market is at or near a top. We'll see if they're right or wrong, but the rise in supply for existing homes will not push prices down. This is my opinion because the real number to watch is new home sales, which is coming out tomorrow in the morning. If the number of new home sales rises higher, then we're seeing legitimate supply arriving to the market. But if existing home sales rise higher while new home sales continue to decline, then we will have this stagflationary phenomena where prices continue to linger higher because the bulk of the activity in the housing market is at the higher end. Meanwhile, the supply is nowhere to be found in the lower and mid-tier of the market. This means that home sales activities will slow down in general, while prices continue to linger higher. Again, this is a stagflationary phenomena. Another piece of evidence of the stagflationary phenomena in the economy right now is the composite PMI that we got in the morning today. The headline number was down, meaning that the pace of economic activity was down, trending down. Private sector companies across the U.S. signaled a further strong upturn in business activity during August. However, the pace of growth slowed to an 8-month low. Capacity pressures, material shortages, underlying shortages, and the spread of the Delta variant reportedly weighed on the output expansion. Here are the details regarding the demand and supply dynamics. Inflows of new business, meanwhile, also softened in August, rising at the slowest pace since December of 2020, led by a marked cooling in growth of demand for services, notably in terms of exports, for which orders fell. Nonetheless, manufacturing firms reported a further marked increase in new order inflows, pointing to a robust demand for goods. Here is the supply side. Severe supply chain disruptions, meanwhile, led to a further robust increase in cost burdens at private sector firms. Midway through the third quarter, the rate of input price inflation accelerated, the second fastest on record since October of 2009, with both manufacturing and service sectors registering a quicker rise in costs. At the same time, the rate of selling price inflation ticked higher as firms sought to pass higher input prices on to clients. Ta-da! You're gonna eat it. You and I, baby. You and I. Sounds like deflation, right? Material shortages, difficulties hiring new staff, and the spread of the Delta variant were all highlighted as factors driving a steep accumulation of backlogs of work during August. The strong rise in outstanding business was only slightly below July's record high and coincided with only a marginal upturn in employment. Staffing numbers rose at the slowest rate since July 2020, often linked to difficulties finding staff. Again, prices rising higher for both the producer and the consumer. They're going to pass that to us. But the pace of economic activities and the pace of hiring is slowing down. This is 1,000,000% stagflation. And here's from Chris Williamson to put all of that data into plain English for us, for our little brains. And I know what you're saying. Bro, I don't care about any of this. I don't give a shit about any of this. Give me tickers. I'm here for tickers. Give me tickers and send me home. I'll give you the tickers in a second, but let's see what this guy has to say. The expansion slowed sharply again in August as the spread of the Delta variant led to a weakening of demand growth, especially for consumer-facing services, and further frustrated firms' efforts to meet existing sales. Not only have supply chain delays hit a new survey record high, but the August survey saw increasing frustrations in relation to hiring. Jobs growth waned to the lowest since July of last year as companies either failed to find suitable staff or existing workers switched jobs, aka quit. Prices charged for goods and services grew at an increased rate as demand once again ran ahead of supply, most notably in the manufacturing sector. Chris Williamson says prices look set to continue to rise sharply due to the persistent upward pressure in cost arising from shortages of materials and labor. Though if demand continues to cool due to rising case numbers, this should alleviate some of the inflationary pressure. Ta-da! And therefore the Fed and their allies, the transitory team, is cheering. Delta, Delta, Delta. Please do something here, because otherwise we're going to be in a stagflation phenomena in this economy, and the evidence doesn't lie. Let's move on and cover the market, shall we? And here we go. The Dow Industrial Average closing in the green by 215.63 points, or a gain of 0.61%. The Nasdaq closing in the green by 227.99, shall we say 228 points, or a gain of 1.55%. The S&P 500 closing in the green by 37.86 points, or a gain of 0.85%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, big energy. At number 2 for the silver, consumer cyclicals. At number 3 for the bronze, technology. What's not working today is the defensive sectors of the market, utilities, real estate, and defensives. Of course, the market is in risk-on mode, at least for now, due to the expectations that tapering will be delayed. What about the advance to decline ratio? NYSE 74% advancing versus 24% declining. The Nasdaq 77% advancing versus 20% declining. All in all, the internals of the market were supportive of the rally today. We have a confirmation within the internals of the market. Of course, the algos went bananas in the morning, buying ETFs, SPY, Qs, IWM, etc., pushing the entire market higher. The tide that lifted all boats, the algos. What about futures? What's going on? The main event was the steep decline in the United States dollar, down about half a percentage point. Right away, crude oil prices, as I told you, popping higher by over 5% for the WTI. Likewise, grains prices also surging higher, led by soybean oil closing in the green by about 3% today alone, followed by oats, canola, rough rice, wheat, and soybean also closing in the green. Meanwhile, modest losses for corn futures, while soybean meal futures suffered declines of about 2%. What about meats? Gains across the board. Milk, live cattle, feeder cattle futures, all participating in the rally. The absence came from lean hogs futures, closing in the red, down by about 1%. What about metals? Surging higher. The dollar is down. This is all what metals futures were looking for, at least for now. Massive gains for palladium, followed by silver, copper, platinum, and even gold participating in the rally today. What about softs? Mostly in the green, led by lumber. Remember the transitory lumber? Lumber rising higher by about 6%, followed by coffee, OJ, cotton. We have sugar futures on the flat line, while cocoa futures closing in the red. Moving on to the big casino. What's going on here? The options market. The hottest table remains Apple, but notice the options volume, by the way, down. So there is no participation here. The algos did the work today. And some look at that as perhaps an excuse to poke a hole in this rally and this pop higher. Perhaps it will not last. We'll see. But we don't have a confirmation from the options volume regarding the rally today. We have confirmation from the advance to decline ratio, but not from the options market. Anyhow, Apple at number one with about 900,000 contracts, about 71.5% of those were calls. Alibaba at number two. They continue to buy the dip in this name, only to catch a falling knife. But Lady Luck treat the dip buyers this time around? We'll see. But Alibaba closing at number two with about 650,000 contracts traded today. About 63% of those were calls. We have Tesla, the souffle, at number three with about 600,000 contracts traded for the name today. About 58% of those were calls. Tesla had some funny business in the morning. Per usual, by the way. Every Monday, we have a pop in Tesla. Somebody pumps and dumps. We'll talk in the charts analysis. For now, we're moving on to the unusual activities that took place in the options market today. Starting with the ticker AMD. They're making a bullish bet here by buying the 119 calls, expiration date September 3rd, with expectations that the name will rise higher by over 10% by then. They paid about 69 cents a piece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker SPY, the S&P 500? They're seeking some protection here by buying the 414 puts on the SPY for the expiration date of October 1st, with expectations that the SPY could drop by over 7.5% by then, and they paid about $2.40 a piece to enter this trade. All in all, spending about $3.2 million on this trade. What about the trade for the ticker FXI? This is for the Chinese ETF. They're making bearish bets here, expecting more pain to come for Chinese stocks by buying the 36 puts, expiration date November 19th, with expectations that the name will drop by over 8.5% by then. They paid about $1 a piece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker PINS, Pinterest? The name is down big after earnings, but we have bargain hunting here. Somebody is buying the 58 calls, expiration date September 3rd, with expectations that the name will rise higher by over 6% by then. They paid about 55 cents a piece to enter this trade. All in all, spending about $600 million. What am I, crazy? $600,000. But in this casino, $600 million could happen. What about the ticker VOS? This is for Bio, Pharma, whatever company it is. Doesn't matter. Do you even care, or do you just care about the ticker? The name was higher by the tune of over 50% today, and they're bidding for more gains to come by buying the 7.5 calls, expiration date September 17th. With expectations that the name will rise higher by over 20% by then. They paid about 80 cents a piece to enter this trade, bringing the total to about $800,000. What about the trade for the ticker AMC for, you guessed it, AMC? The name rising higher today, and they're bidding for more gains to come by buying the 39 calls, expiration date this upcoming Friday, August 27th, with expectations that the name will rise higher by over 5.5% by then. They paid about $1 a piece to enter this trade. All in all, spending about $900,000. What about the ticker QQQ for the NASDAQ? Just in case you did not know. But this one is interesting, by the way, because it is a bullish bet, a bold one, on the NASDAQ. What does that say about yields, about the dollar, about tapering? Who knows? But this is an interesting one. They bought the 395 calls with the expiration date of November 19th. With expectations that the Qs will rise higher by over 6% by then. They paid about $4 a piece to enter this trade. All in all, spending about $3 million. Lastly, what about the trade for the ticker BABA? For Alibaba. In this case, they bought the 170 calls, expiration date September 17th, with expectations that the name could rise higher by over 6.5% by then. They paid about $6.50 a piece. This is a big one. $6.50 a piece, it means $650 per contract. All in all, spending about $4 million on this trade alone. Moving on to the heat map analysis. Anything to see here? Of course not. The market is blasting higher from risk off to risk on, and therefore dumping utilities, dumping real estate, dumping defensives, and even healthcare. Last week, when we had quote unquote volatility in the market, and by volatility, we mean a red day, a red candle these days. These sectors of the market acted as safe haven to park cash. Healthcare, REITs, utilities, defensives, dividend paying stocks. But now, at least for today, when we switch to risk on, we're going back to the inflationary trade, we're going back to tech, we're going back to chips, we're going back to the reopening trade. We will see how consistent this theme is. But for today, the dollar is down, yields are down, slightly flat. We have Jackson Hole canceled, but most importantly, we have so-called hawkish Fed members, Fed presidents, the likes of Kaplan, now suggesting that perhaps we could wait on tapering until we get more clarity regarding Delta, etc., etc. So the dollar goes down. We get that. No tapering, more coke. The dollar goes down. But what's going on with yields here? Are we going to trust the modest down day in yields today and assume that yields will continue to go down, at least at the higher end of the yield curve? Because what's moving industrials, for example, energy, materials, what's moving these sectors of the market higher was the decline of the US dollar. What moved the tech sector of the market higher is the decline of yields and the prospects of a delayed tapering. But what happens if yields decide to go higher? Hey, you know what? Jerome is not going to taper, allowing inflation to continue to rise higher, and therefore yields will go higher. Who knows? For now, you got to watch the dollar and yields and watch how they react in the next few days, because what you see in the map right now might change by the end of the week. Might. And the likelihood is it will. We're moving on to the charts analysis, starting with the SPY 30 minutes chart. What's going on here? A massive shot higher, nice hit of coke in the morning, and what do you know? The market blasts higher. Can you fight this? Of course you can if you want to, but is it wise to do so? We've seen pumps and dumps in the market before. We've seen gaps and craps before, but nothing will change right now so long as the United States dollar continues to trade down and yields stabilize or trade slightly higher. This is what the market is watching for, and if this scenario continues, it will be good for stocks, and we will see a follow-up to the pump we saw today. What about the daily chart for the continuous contract on the SPY? The chart continues to bounce off the trend line and now trading at all-time highs. Again, is this bullish or is this bearish? The answer is it is bullish, trading at all-time highs, above the trend line, above the last support of 4,384.5. It is ridiculous, but you got to remember we are in the ridiculous bizarro freak show market casino that the Fed made for us. So this wasn't just normal. This was expected. Market participants been buying the dip aggressively, believing that the market will not go down. There is no way the market will go down. Stocks only go up unless the dollar continues to rise higher, flips 180 and starts to bounce higher, and we see yields popping higher significantly. We're not talking 1.4, 1.5, we're talking 1.7, 1.8 to 2%. Until then, the market will continue to hold and move its way higher, with the exception of a surprise, black swan, market accident, a margin call, somebody blew up. Absent of that, so long as the coke continues to flow in the right direction to the market, $120 billion minimum a month, the market will continue to go higher and the dips will continue to be bought, specifically now that we are expecting and starting to price in a delayed tapering. Now, for this chart, technically speaking, the reversal will not happen until the chart breaches 4,384.5 and the trend line. Absent of that, the direction is higher. What about the Qs? 30 minutes chart. Also blasting higher in the morning, gap, and continue to gap. Massive green candles combined with low volume. This is classic algorithmic buying. There was a program in the morning and it went with very little resistance because institutionals are buying, they're not selling. Combine that with the retail side also buying every dip, and we have this massive cartoonish pop higher. Now the Nasdaq is watching yields, not so much the US dollar. but yields. And if yields continue to be stable or trade a little to the downside, this will be even better for the Nasdaq to continue to rally higher. But if the 10-year yield suddenly decides to do a 180 and pop higher, then perhaps the Nasdaq will not participate in the rally along with the inflation trade of energy, financials, industrials, and materials. What do you do with this chart? Nothing. All-time highs? The sky is the limit for now. If it goes down, you have the gap to look forward to. Watch out the reaction at that point, and we have 365.5 for support for now. What about the daily chart for the continuous contract on the Qs? Popping higher, a massive cartoonish pop higher, a vertical line higher, and now we're trading at all-time highs. Can you fight this? You could, at your own risk, of course, because there is nothing wrong in the chart right now, and you have the momentum indicators also strengthening, but I am still skeptical on this one. I'm putting a thumbs down, not due to the technicals, but due to other factors, the psychology, the seasonality, etc., etc. I think there is a trap here, but again, we do not trade based on intuitions or superstitions. We trade based on the facts, and the facts say there is no reversal here, there is no sign for any reversal on the Nasdaq, and there is not even a sign of weakness on the chart. What about the IWM? What's going on here? 30 minutes chart. A nice way to beat any resistance level is to cheat, and you cheat by gapping higher in the morning above the resistance level. That way the job is easier rather than building your way higher. But the problem is in charting behavior. When you gap up higher above a resistance level, you leave a gap open. Usually you have to go down and close these gaps. This is normal charting behavior because these pops higher are usually impulsive and premature, and the market at some point finds its rationale and says perhaps we went a little too far too soon here, and it goes down to close the gap. Of course, this doesn't mean that the chart cannot go higher, but it means the likelihood is that the chart has to go down at least to retest the support of 218 for now. So I'm watching for a retag to 218 and then take it from there. If the chart breaks the support of 218, then the likelihood is it will go down to close the gap. But for now, you gotta wait for the reversal. For all you know, the IWM could be eyeing 223 as the destination, and it will not stop until it gets there. It will continue to fight throughout the week to get to the destination. I doubt it. I think 218 is more likely than 223, but we'll see. What about the Dixie? The most important chart to watch here. It did not breach the support of 93, at least not right now, but it could do so any moment now. But you gotta watch this chart extremely closely because if at any point throughout the week, say Powell says, yes, we canceled Jackson Hole, we're gonna do it virtually, but we did not change our stance regarding the possibility of tapering in October. If that happens, then the Dixie will reverse 180, pops higher again, and all of this pop in the market will reverse. So this is the key to the market right now. Breaching 93 will confirm that the market is becoming more convinced here, with perhaps a little more conviction that the Fed will not taper, not in September, not in October, not in 2021 at all. And this is good for gold, of course. Gold is rising higher again, but gold has many enemies, as you might know already. One of them is the US dollar. Okay, the dollar is down. Yields are down today, but is there any guarantee that yields will not reverse and pop higher again? We have plenty of macro data throughout the week. Anything could spark yields higher again. We see the dollar down, yields higher, which is good for the inflation trade, but not so good for the Nasdaq. And for gold, by the way, because gold has an enemy in yields. 1.3, 1.4, not a problem for gold. But if we get to 1.5%, 1.6, then gold will start to show some weakness here. Here it is, yields. What's going on? Still trading below 1.28%. Waiting and waiting for a definitive move. This is not a definitive move. It was a definitive move in the Dixie, the US dollar, but not in yields. Yields pretty much trading flat, slightly to the downside. We need a confirmation here, up or down. Similarly, when we talk about yields, we have to talk about the TLT, a weekly chart trading above 149. The assumption is the TLT will continue to rise higher until and unless the bond market decides to read things differently, that perhaps the delay of tapering will allow inflation to rise higher. Absent of that, the trajectory for the TLT, at least for now, is higher. What about the VIX? What's going on here? We have a crossing creating red impressions on the histogram of the MACD indicator. This is a signal and sign that the pop is over. It resulted in about 60% gains for the VIX, but now the VIX is down, trading at around 17 and below, well below 20. Are we going to see another pop in the VIX? Perhaps. You have to watch the MACD indicator. What about Apple? What's going on here? Still within range, but now knocking and knocking and knocking at the doors of 150. The odds say that Apple will be able to break above 150, but we don't have a trade yet until the break happens, until Apple closes above 150 for the day, perhaps for the week, as a final confirmation. Then we have a trade of perhaps buying the 155 or 160 calls as the energy from the consolidation gets released. But this will not happen until Apple closes above 150, confirming that 150 is no longer resistance. Matter of fact, it is support. What about Tesla? What's going on here? 30 minutes chart. Massive pop higher along with the market. We had some funny business in the morning, per usual, of course. Somebody buys an insane amount of Tesla call options every Monday, pumping the stock higher.
Next, I got Tesla for you. Early in the trading session, the first 45 minutes, stock was trading right around 680 all the way up towards 700. We had the 720 calls that expire on Friday being bought. They bought a big number, 13,500 of these. They started off at $2.50, paid all the way up over $5 for these calls. I'm in these calls as well. I only got this week. Everything we're seeing, as I said earlier, very, very short term. This is a great example of that.
And of course, they buy them for the weekly expiration, meaning a pump and dump quickly, pumping on Monday, perhaps dumping on Tuesday or Wednesday, and leaving some people holding the bag. Therefore, still skeptical that this rally, this pop higher in Tesla, will result in any follow-up. There is no legitimate buying here. The buying is done via a gamma squeeze in the options market. As you can see, I'm highlighting every Monday there is a pop via options, and then they dump right away. So absent of a confirmation, the confirmation will be closing above 720. You got to close above that level. If that happens, then we have a confirmation that Tesla is about to blast higher. Absent of that, these pumps are just going to be pumps and dumps with no confirmation. What about BTC? What's going on here? The chart is struggling to break above 50,000. It's running out of gas. You look at the momentum indicators, the MACD, the RSI, it is running out of gas. It will only continue to pop higher if there is new blood, new entrance into BTC from the retail side, a new mania building up. Absent of that, the likelihood is the chart will top here. It will pull back to 42,000 once again before bouncing higher, but we'll take it from there. For now, is this a buyer market or is this a seller market in BTC? At these levels, specifically if you joined the rally from the very beginning, you're up 70, 60, 50% if you waited for a confirmation. What more do you need? Greed at some point is not good. 50,000, a good exit point. And of course, if you listen to me and you end up missing out, the FOMO, and BTC goes to 60,000, 70,000, feel free to write an email to our complaint department. But we're moving on to AMC. What's going on here? Blasting higher, trading above 32. 32 has to be defended, but you have to push the chart a little higher. 40s, perhaps all the way to 52. The resistance, the most important resistance here, because if the chart rallies all the way to 52, then we're going to have repair done in the weekly chart, preventing, or shall we say delaying, the inevitable, which is a crash in the stock once it breaks 32. Moving on to the conclusion of this video. What do we have on the economic calendar? Tomorrow, we have new home sales. It will be interesting to see if new home sales also rising along with existing home sales, or is this a divorce where existing home sales rise higher, new home sales down? What are the implications on the price of lumber and home builder stocks, the likes of Lennar, Toll Brothers, D.R. Horton, etc., etc. Anyhow, folks, that's all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.